What is going on, traders? Welcome back to the Traveling Trader, back in the US finally. I wanted to alert you guys on something that is brewing in the financial markets. We've talked about several of these concepts before. However, the next financial crisis, or really the big bubble burst, could happen in bonds as opposed to stocks. We've already seen stocks draw down. More than 50% of the stocks in the indexes have gone down over 50% this year. A lot of them have hit, most of them have hit 52-week lows already. However, the next crisis could really be in bonds. Now, we talk about bonds a little bit depending on what issues we are discussing. And certainly they are a huge part of the macroeconomic landscape, especially because the bond market is much bigger than the stock market. But in this case, remember who is holding a huge amount of bonds and treasuries at the moment. It is not an institution. It is not a money market fund. It is not a big whale. It is simply the Fed. So if we take a look at the Fed's balance sheet, you could see that it still hovers around 9 trillion. It fell finally just under 9 trillion at around 8.8 trillion. However, they are going to be rolling off assets off the balance sheet at a pace of $95 billion a month, which would translate to about $1 trillion off of the balance sheet every single year. Now, I took a look at some data that is actually very shocking. Obviously, we have the data regarding the Fed's balance sheet, but I took a look at what the bond holdings are, what the treasury holdings are by different types of institutions, and the fact that they are currently maxed out. So why is this a danger? Well, it's a danger because if these treasuries are being rolled off of the Fed's balance sheet, there has to be buyers there ready to basically inherit those or digest those, or else there's going to be a huge imbalance in bonds, meaning that if the Fed lets $95 billion worth of treasuries roll off and the market doesn't purchase at least an equivalent amount, well, then what happens to the bond market? Same as what happens to any market. Think of, you could break it down to cars or vegetables or whatever, any market that requires buyers and sellers, right? If there is a huge influx now of supply into the market and there isn't a similar number of takers in order to prop up demand, well, then you have an oversupply and that market tends to burst. Those bubbles tend to burst. Well, what does that mean in terms of the bond market? You may say to yourself, well, I don't have any bonds. I'm not interested in bonds. I don't care. However, as I stated before, the bond market is much bigger than the stock market, and the bonds have an inextricable tie and effect on equities and on companies because bonds are the tool that banks use in order to set interest rates, right? As bond yields rise, well, interest rates of everything goes up, including mortgages, cars, the cost for businesses to borrow money, the cost for you to start that small business that you've been wanting to start, the cost of student loans, everything goes up. That's why, small changes in interest rates like 0.25% might seem minuscule, but they do have large ramifications in the market because interest rates really touch each and every single part of the market. So in this case, when the Fed allows assets to roll off of their balance sheet, let's take a look at banks, foreign holders, money market funds, mutual funds, pension and insurance funds. And if you take a look at where they are currently, the holdings that they currently have, it is in this light blue color here on this graph versus the holdings that they had in 2017 when the Fed started rolling assets off of the balance sheet, and what the recent historical high is denoted by this diamond. I'm not going to take a look at the green bar. That doesn't really matter. But if you take a look at where, these institutions, where their current treasuries and bond holdings lie, a lot of them are near the historical highs, right? Or very close to the historical highs. So banks, foreign holders, mutual funds, pension and insurance are very close to their historical highs of the amount of holdings that they have in bonds and treasuries. Money market funds are still a ways away, but I don't think this is still enough of a gap in order to intercept the influx of treasuries and bonds that might be hitting the market when the Fed actually starts selling the stuff. So if you take a look at the Fed's balance sheet, we're still very high, and the Fed has a goal of letting assets roll off as well as raising interest rates until we have price stability, right? And before COVID, the Fed's balance sheet was actually more than half off from what it is today. It was at around $4 trillion. Currently, we sit, as I said, at around $9 trillion. So imagine what happens when these bonds hit the markets and there is literally nobody to intercept these. Well, what's going to happen is that yields are going to go up, because when nobody buys bonds, yields go up in order to attract buyers, right? So when bond prices go down, yields go up, and vice versa. So if nobody buys these bonds are going to tank, the bubble's going to burst, and yields are going to rise likely. And when yields rise, well, that is not good for stocks. That is one of the reasons why the stock market is crashing, is because of the pace at which the Fed is raising rates. But obviously, they have no choice. They should have done this earlier. They're now playing catch up. And so they're having to do what is likely going to be back to back to back 75 basis point rate hikes. And when bond yields rise, if we take a look at the 10-year, you can see that the 10-year is currently trading at a 10-year high. It has not been this high since 2011. So that is part of the reason why stocks go down, because there is an inverse correlation between bond yields and stocks. And if we take a look at the stock market, as of the time of this recording, of course, we're going to be doing TA Tuesdays, TA Thursdays. I will drop another video tomorrow as of the time of this recording, but you could see the drawdown that stocks have had with those rise in bond yields. Really, since August, stocks have gone down, at least in terms of the SPY. The SPY is now down almost 10% since August, right? And that is largely due to the rising bond yields. And the other thing is obviously the Fed funds rate, right? Like I said, the Fed is likely going to do another 75 basis point rate hike on September 21st. Especially with a hot inflation report. Inflation came in at 8.3% year over year versus an expected 8.1%, right? So especially with a hotter than expected inflation report, you could see now that if you look at the Fed watch tool, there is no way that the Fed is going to do less than a 75 basis point rate hike. As a matter of fact, it's 72% likely it's going to do a 75 basis point rate hike, and 28% likely they're going to do a full percentage point, 100 basis point rate hike, right? With that said, the Fed is going to have to raise the rates so that the Fed funds rate is above CPI, and CPI right now is just not letting down. Now, the Fed funds rate, the effective federal funds rate, as I said before, has been negative really for most of the time since the 2008 financial crisis. And we've never gotten out of a bad inflationary period in the US until the Fed funds rate is above CPI, making the federal funds effective rate, which is the Fed funds rate minus CPI, positive, right? Until the Fed funds rate is risen enough above CPI so that this is positive. That is the only thing that is going to get us out of an inflationary mess. And if you don't believe me, just take a look at the Fed's charter. It's right here in the Principles for the Conduct of Monetary Policy. It says a third principle is that the central bank should raise the policy interest rate over time by more than 1-for-1 in response to a persistent increase in inflation, and lower the policy rate more than 1-for-1 in response to a persistent decrease in inflation. For example, if inflation rate rises from 2% to 3% and the increase is not caused by temporary factors, the central bank should raise the policy rate by more than 1 percentage point, right? So there you have it. It's in their own charter that their goal, their mandate dictates that they raise the federal interest rate or the Fed funds rate above CPI, right? We are not right now in an economic emergency. Again, this is something that they should have been doing already, especially when we were in an economic boom coming out of COVID, and not now when the economy is slowing down. But they have no choice because inflation is running way, way too rampant at 8.3% year over year. And I'm going to go over this when we do our TA Tuesdays / TA Thursday, our next session. But if we close below the golden pocket here, because we will likely retest it, right? If we close below this golden pocket here on both the SPY and the triple Qs, both the S&P 500 and the NASDAQ, I will likely open up another doomsday portfolio full of puts like the one that I had closed during the middle of this rally here, because I didn't want to lose all my gains on those puts. But I will likely open another one if we confirm a close below here, because at that point, in my view, we are for sure testing those June lows and potentially below, depending on what happens with the economy and how long a recession is going to persist, right? How long an economic slowdown is going to take. One thing we haven't seen yet is what we call earnings compression. So we saw multiple compression, right? Where companies' multiples, their valuations, basically remain unchanged or go down even with similar or increased earnings. And the second shoe to drop is going to be an earnings compression, where the economic landscape, finally has an effect on companies' earnings, and you see these mega cap companies start lowering guidance. Right? It seems out of the realm of possibility, but you will likely start to see companies like Microsoft, like Tesla, like Apple, they're going to be lowering their guidance ahead of earnings, and they're likely going to be reporting less earnings than they did in the last few quarters. And that is when you will finally get what we call earnings compression. And if that happens, during a drawdown in the markets, and if the economy tends to slow down, then it is very likely that we will get below these June lows. But if we cross below this, again, I'll go over this in detail. But if we cross below and close below this, I would likely open up another doomsday portfolio to take advantage of this drop down here that we will likely get to those June lows. And if you want access to all of these trades that I'll send out in real time, if you want access to the chat, the Zoom calls, the courses, the day trading course, the options course, link is in the description. We opened up signups for September because they had run out in August, but we opened them back up for September. So sign up and book a free call with one of our ambassadors. Would love to have you guys. Anyway, leave a comment down below. Let me know what you think of the Fed funds rate. Let me know what you think of the Fed's actions. Do you think they're going to do a 75 basis point rate hike or a full percentage point rate hike? Let me know what you think of the potential of a bubble burst in the bond market and what effect that is going to have on stocks. Hit that thumbs up if you got anything out of this video. Subscribe, hit that notification bell. Stay safe out there, traders. Peace.